Matt the Mortgage Guy, Mortgage Mondays, episode 119. Well, I've got a mortgage tip. Why rate is more important than price. Matt the Mortgage Guy, Mortgage Mondays, episode 119, where I'm talking about rates being more important than price, and for all intents and purposes, the cost of waiting. So I've got a ton of buyers who I talk to say, I don't know, Matt, prices are high. I don't really think I want to buy right now. I'm going to wait it out. I'm going to see if prices come down. I got realtor partners that have buyers saying the same thing. So for my realtor partners and for buyers out there, here's a little video why I think waiting might be a very scary proposition. So I'm going to use clear-cut examples so we can just see the numbers. And for my first example, let's take a $400,000 house, 30-year fixed mortgage, and we'll use 4.875% interest for our example for a mortgage today. Principal and interest payment on that is going to be $2,011 per month if you put 5% down. Finance $380,000 of that $400,000 purchase. So if that same house depreciates by 5%, because we're going to just hope, we're going to hope and pray that the market slows down and we see depreciation next year. Some forecasts say that we're going to see a decrease in the appreciation, but probably still 3 to 4% appreciation. But let's just say your dream came true. Prices decreased by 5%. You can buy that same house for $380,000. You put the same 5% down, but now rates are up 5.875. And this isn't some long shot number. 5.875 is a 1% increase. And for all the smart money out there, rates increasing 1% over the next year is very likely. The Fed was pushing mortgage rates down by buying mortgage-backed securities like $50 billion a month. As of October 1st, 2018, they stopped buying altogether. It was quantitative easing. It went away. Rates have nowhere to go but up. They've already ticked up quite a bit since the Fed was decreasing what they bought and ended at 0 per month, October 1st, 2018. So 1% increase in rates. $380,000 with 5% down, $2,135 a month is your principal and interest. So scenario where the price goes down 5%, but the increase in interest rate goes up 1%, you're paying an extra $125 per month. In interest over the life of that loan, you're paying an extra $65,000. Okay, Matt, I don't like that example. I'm going to wait till prices go down 10% because I'm going to bet on that. I wouldn't bet on that, but let's say you do. Prices go down 10%. You buy that same house for $360,000 and rates have gone up 5.875%. You're still paying more per month, $2,023 per month. So that's just a quick example of why if you are targeting a specific area and you have a neighborhood you want to live in, the interest rate that you can get today isn't guaranteed tomorrow. And even if you have some long shot dream about prices coming down, the more important piece is getting into a good mortgage. So another example for you, because I think the more likely scenario is that prices don't decrease, but say they flatten out. The appreciation we've been seeing for the last few years isn't sustainable, 7, 8, 10%, so it's 2 or 3%. Or in this example, we'll call it 0%. That same $400,000 house a year from now is still $400,000, but rates are 4.875. Guess what happens to your payment? It goes up $236 per month because you waited and rates went up 1%. Over the life of that loan, you're paying an extra $100,000 in interest. That's scary to me. So, final example, prices increased by 5%. And after a seasonal slowdown here in fall of 2018, next year we see some regular spring activity and prices increase again. And that same house you wanted to buy for $400, it's $420 now. You're like, oh shoot, I'm going to buy it. But prices are rates are 5.875%. That same house, $400,000, 4.875 today, 1 year from now, $420,000, 5.875, $2,360 a month. That's an extra $350 a month on your payment. Not only that, over the life of the loan, the numbers are roughly $107,000 extra in interest. So something to chew on. Any questions at all, please feel free to reach out. Happy to help. Until next time, Matt the Mortgage Guy.